Let's dig a little bit deeper. You talk about the overall trend. Again, do you think that Powell, obviously, you know, they said that he potentially had access to this data. He pushed back against the concept of a hike, and he signed a particularly dovish, and he was convinced that we were in restrictive territory. Do you think this is the beginning of understanding what the incremental impact of restrictive rates is?
So, yes. I mean, I would say a couple of things to that. One, I think the chair was very clear about the bar for hiking rates was extremely high. And I think that was a big deal for the markets. I think he basically took off the table that they're considering that anytime soon, and that you should just sit back and wait and see, and the data will start to move in a direction that allows them to start the cuts. I think that's a big deal for markets. Listen, and particularly in fixed income, people are sitting on immense amounts of cash. You see this in money market funds, you see it in deposits. And boy, anything that for the markets gives you some sense, okay, you know, they're not considering rate hikes anytime soon. I can feel a little bit better about putting money to work, and the income levels you can generate are substantial today. So, you know, your comment earlier about unleashing the hounds. I don't know about the hounds, but I think there are a lot of people who are saying, I just don't want to get bludgeoned by rate moving higher. And listen, I think, you know, when you look at some of these numbers, healthcare in today's number was healthcare and education, 95,000, 175,000. So if you strip out healthcare and education, not cyclical, not interest rate sensitive to any significant measure, you know, we're talking about an economy that is slowing a bit and allows the Fed to move. And then this gets people comfortable that, gosh, I can put some money to work, particularly at these yields that we haven't seen in a couple of decades.
Well, we haven't. Let's just talk about the yield moves today and this week. Two's down 11 basis points, give or take a tick. I need to refresh my price. Down 23 basis points on the week. 10's down 10, down 19 basis points on the week. Have you been actively deploying? Would you be an advocate of active deployment into this market this week? I mean, the ECI was just a couple of days ago, and we were freaking out with that. So just contextualize those kind of moves for me this week and today.
So I think there's something pretty spectacular in markets today in fixed income that is worth sitting back and taking note of. If you're holding income today let's say in the front to the belly of the yield curve, and then we talked about it last time on the show and the time before that, the yield is so let's say that rates stay here. Let's say rates move up a bit. If you can carry, in my ETF, we're carrying almost 7% yield. And you think about what that means. Every single month, I'm throwing off 55, 60 basis points of carry. So let's say rates move up a bit more. Gosh, it'd take you a month to work through that in terms of because your income level's so high. So if you said to me, have we been doing things? Yes. You know, do I like owning these yields in this front belly? And do I like owning income, investment grade credit, some mortgages, some securitized assets, high quality assets? You know, you could throw in a bit of high yield. Boy, this is, I mean, I've been doing this a long time, like for a decade or longer than that. You're saying like, God, I gotta own some risky assets because yields are close to zero. Today, I mean, you could feel pretty comfortable because your income and your carry is so substantial of holding some of these assets, and your return will be pretty hard unless you think rates are going much higher, which is almost inconceivable given the moderate deceleration in the economy. Then you feel pretty good about owning that part of the yield curve. You know, longer in interest rates. You know, tougher story. Do you need it with a curve this flat? I don't think you really need a lot of long interest rate exposure.
Look, the market has decided to put its stake down in the ground today. It's turned the page on higher for, I would say that the market has decided to turn the page on higher for longer and to reflect. Perhaps not just as high for not just as long. Is it too early to do that?
So, listen, I think you have to assume there's an extraordinary amount of, we're in this era of infrastructure spend, climate spend, AI spend, you know, the energy that has to go in around it. There's a lot of capital that's got to come in simultaneously or be put to work to support this sort of CapEx and R&D spend in the economy. Secondly, you have a dynamic where, I mean, you look at these payroll numbers and you go back a ways and think about, you know, why are wages this elevated? There's actually not enough people without immigration. Certainly, there's not enough people for the roles that are out there. So I think you have to assume that we're going to be at a higher, and by the way, the Treasury's got to issue an awful lot of debt.
Yeah.
So you've got to assume we're at a higher interest rate threshold than you've been at historically. But, you know, it's also why you're seeing a lot of asset allocation. Every day I see this. People say, I own equities. By the way, I still think equities make sense. I own equities, but boy, I can create a bit more balance in my portfolio, clipping coupon, clipping some income, and these yields are pretty attractive. I mean, most, if you take endowments, foundations, pensions, they have a return target in and around 7%. You had to get it through equities. You had to get it through alternatives. Today, boy, you can get it through some fixed income assets with not a lot of volatility, not a lot of beta to them. That's a pretty unique point in time.
I came across a lovely phrase from Bank of America this morning, so bear with me on this, because I quite like it. Crashes in cocoa, corrections in crypto, and wobbles in gold. And the thesis is those bubbly assets of 2024 showing signs of a higher for longer stance is now percolating through the market. But you extrapolate that a little bit further. You talk about non-mortgage interest rate payments. So put your thesis to bubblicious. I mean, bubblicious could be blowing up according to Bank of America. You've got a slightly more intellectual take.
Oh, I don't know about that, but I would say, listen, I've done a bunch of presentations recently to show what's happening when you keep the interest rate this high. You're actually putting a lot of pressure on lower income. You're putting a lot of pressure on local banks. You're putting a lot of pressure on commercial real estate, small business. You have an economy that's very disparate today. You've got part of the economy that is a borrower. That is really getting hurt. And you're seeing that when you look at the earnings reports, you look at the dispersion in some of the lower income, some of the small business versus some of the big business companies that don't have to fund themselves. Look at big cap tech that funds through free cash flow, buying back huge amounts of stock. Not not at all really interest rate sensitive. So you have what is a two-part economy. And, you're witnessing part of why I think the Fed needs to bring that rate down over the next, certainly the next few months is, gosh, it is pressuring. And I think where Chair Powell is right in a lot of ways is there is some real restrictive behavior here, but it's impacting a part of the economy, and the pressure there has become pretty acute. And you're starting to see that in the numbers.